This video sponsored by BuyMote.
Index. RSI is a momentum oscillator that measures the speed and change of price movements. Since it's an oscillator, it provides a value between 0 and 100. With the default settings of 14 period, the RSI compares the current price with the last 14 bars. When we lower this number to, say, 7, the RSI becomes fast, leading to more extreme readings. On the other hand, when we increase this number to, say, 30, the RSI becomes slow and extreme readings become rarer. The extreme readings are very important to understanding and predicting the price movement. When the RSI goes above 70, the price is considered to be overbought. In such a scenario, the price is expected to reverse downwards. Similarly, when RSI goes below 30, the price is considered to be oversold. In such a condition, the price is expected to reverse and move upwards. However, these overbought and oversold conditions can change as the price moves in different trends. For instance, in an uptrend, the overbought zone moves from 70 to 80. Similarly, the oversold zone moves from 30 to 40. On the other hand, in a downtrend, the overbought zone comes down to 60 and the oversold zone moves down to 20. But still, these overbought and oversold zones are just a reference to where the price is. These are not trade signals, and you should never trade based solely on this. Generally speaking, in an uptrend, the RSI can remain overbought for a long time without any pullbacks. In such a scenario, if you place sell trades because of the overbought condition, you will make losses. However, in an uptrend, you will notice that the price respects the oversold levels to a greater extent. Whenever the price moves near the oversold area, we almost always see an upside reversal. The same principle applies to a downtrend. In a downtrend, the price tends to stay oversold for long durations without any pullbacks. Buy trades here will lead to losses. However, the price tends to respect the overbought levels to a great extent. Whenever the price moves near the overbought level, we almost always see a reversal. The dual RSI trading strategy uses this to its advantage. The RSI can also be used to identify market trends. A simple way of doing this is to mark the 50 line on the RSI. If the RSI is above 50, the price is considered to be in an uptrend. Similarly, if the RSI is below the 50 line, then the price is considered to be in a downtrend. But the problem is that sometimes, when the price is in a consolidation, the RSI revolves near the 50 line. It constantly crosses the 50 line, and it can be extremely frustrating to identify the trend in such cases. To avoid this, we can use the 60-40 method. Here, we mark the 60 and 40 lines on the RSI. When the price is above 60, we will consider the price to be in an uptrend. On the other hand, if the RSI is below 40, we will consider the price to be in a downtrend. If the price is between 60 and 40, we will consider the price to be in a sideways market. Pretty simple, right? Now, let's understand how to use these concepts for our trading strategy. Dual RSI trading strategy. This strategy is a trend trading strategy. When the price moves in a trend, it generally does this by creating large swings in the direction of the trend. A single price swing consists of two parts, an impulsive move and a corrective move. For trend traders, the ideal time for entry is at the end of a corrective move. When you enter at this price point, you can capture the next impulsive move. Therefore, we will try to find entry near this area as well. To do so, we need to do two things. Number 1, identify the trend. Number 2, identify the entry. We will use the RSI to do both of these things. Firstly, we plot two RSIs on the chart. We change the period of the first RSI to 7, and we change the time frame to 1 day. This gives us the value of the RSI on the daily chart. We will change the overbought and oversold boundaries to 60 and 40. Once we set this up, make sure to change the color of the RSI to something different from the other RSI. For the purpose of this video, I will keep it orange. Now, the orange RSI will help us identify the market trend on a higher time frame. If the RSI is above 60, the price is considered to be in an uptrend. Therefore, we will look for buying opportunities. Similarly, if the RSI is below 40, the price is considered to be in a downtrend. So we will look for selling opportunities. The second RSI is the one that will help us to identify the entry points. On the second RSI, we will change the period to 7, and we will change the overbought and oversold levels to 60 and 40 respectively. Now that the chart is ready, let's discuss the rules of the strategy. The dual RSI strategy is a swing trading strategy, so we will use the 1-hour chart for our entries and exits. Once we are ready to trade, we first need to identify the trend of the market. To do that, we will look at the orange RSI. On this chart, the orange RSI is above 60, so the price is considered to be in an uptrend. In an uptrend like this, we will look for buying opportunities. Now, we will look at the second RSI and wait for the RSI to be below 40. Here the price went oversold and we saw two doji candles. We can also see that the price is near a support level. All of these are signs that the price is likely to reverse and move upwards. Now all that is left to do is to wait for the RSI to go back above the 40 level. The next candle was a big green candle where the RSI rose above 40. Technically, our entry was here, but since the candle was really big, we cannot trade it. If we enter here, our stop loss will be below the recent swing low. And as you can see, the stop loss is too wide, so we wait. A few candles later, the price comes back into the support and goes oversold again. This time the price creates an engulfing candlestick pattern as the RSI moves above 40. This is a 5-star setup, so we enter a buy trade at the close of this candle. We keep our stop loss below the swing low and target a 2:1 risk-reward ratio. As you can see, the price achieved our targets on this trade. Now let's look at a sell trade. On this chart, we see that the orange RSI was clearly below 40, so we can say that the price is in a downtrend. In a downtrend, we will look for selling opportunities. A selling opportunity occurs here as the price pulls back and the RSI crosses above 60. We see the price stall and move downwards. This little reversal occurs at a resistance level, which adds to the confluence. Our entry occurs on this candle as the RSI moves back below the 60 level. We keep our stop loss above the swing high and target a 2:1 risk-reward ratio. As you can see, the price achieved our targets on this trade as well. And that is the strategy in its simplest form.